As the U.S. markets are currently closed, we're looking at the figures from the last market session. Nuburu Inc., trading under the ticker BURU, finished yesterday's trading session on October 22, 2025 at $0.361 per share. This wasn't just a normal day. The stock exploded upward by $0.070, a massive gain of 24.34%, an absolutely enormous move for any stock, let alone one in this price range. And here is the immediate, jarring piece of information you must reconcile with that 24% gain. For the first quarter of 2025, which ended March 31, this company reported total revenue of exactly $0. Not a million, not 1,000, zero. That is the central tension of this stock right now. The expectation, driven by yesterday's news, is that this company is on the verge of a massive new opportunity. The reality is that its existing operations have, based on its last report, ground to a complete halt, and the stock is trading for pennies. So, what on earth could send a stock with no reported quarterly revenue up 24% in a single day? The answer is a press release that completely shifts the company's narrative. Nuburu announced yesterday that it has entered into a strategic framework agreement alongside its subsidiary Nuburu Defense LLC to form a joint venture with Maddox Defense. This isn't a small-time agreement. The new JV, which will be controlled by Nuburu's defense arm, is being set up to develop, manufacture, and deploy advanced drone systems for both military and commercial customers. The target market is significant. They are specifically aiming at NATO and allied customers, estimating the NATO UAV defense market opportunity to be somewhere between $7 billion and $10 billion annually. This is the story that traders on platforms like Robinhood and SoFi Invest saw, and they piled in. The volume yesterday was staggering, hitting nearly 519 million shares, an absolutely astronomical figure compared to its average. The expectations set by the press release are even more specific. The company stated that this new joint venture anticipates reaching approximately $100 million in annual revenue by the end of 2028. It also projected a cumulative haul of $165 million across the 2026-2028 period. For a company whose market cap is hovering around $47 million, the idea of $100 million in annual revenue completely reframes its valuation. This is the narrative. This is the expectation. It's the dream of getting in on the ground floor of a new defense tech player, a story that is far more compelling than its original business. This agreement is part of a much wider and very recent strategic pivot. Just a couple of weeks ago, on October 7th, Nuburu announced a binding agreement for its defense subsidiary to acquire Orbit SRL, an Italian software-as-a-service provider focused on operational resilience. You can see the pieces being moved on the board. The company is aggressively trying to build a new defense and security hub from the ground up, combining hardware, drones via the Maddox JV, with software, resilience via the Orbit acquisition. Yesterday's 24% spike was the market's validation of that pivot. Now, we must turn to the reality. This is where professional analysis separates from the hype. The reality is that Nuburu, as it stands today, is a micro-cap company in a precarious position. Let's look at the numbers it has actually posted, not the ones it hopes to post in 2028. As mentioned, Q1 2025 2025 revenue was $0. Its full year 2024 revenue was a mere $152,130. That was down from $2.09 million in 2023. This is not a slowdown, it's a near total collapse of its legacy business. This is why the stock is at 30 cents per cent. It's not a hidden gem, it's a company whose original business model appears to have failed. This pivot into defense isn't an expansion, it looks like a desperate, albeit ambitious, attempt to find a new lifeline. The company's credibility has also taken hits. Just on October 13th, Nuburu announced it had received a warning letter from the NYSE American Exchange for non-compliance, specifically for failing to provide required advance notification before a press release about its new dual CEO structure. While the company stated this was resolved and it's back in compliance, it's not the kind of headline that inspires confidence in operational discipline. This makes trading BURU an exercise in high-risk speculation. This is not a stock you find in Schwab Intelligent portfolios or a stable Fidelity mutual fund. This is a pure narrative-driven trade. The volume we see is likely dominated by retail traders using Robinhood stock trading or SoFi active investing platforms, trying to catch a multi-day runner. The institutional ownership is almost non-existent. Filings show only about 18 institutions hold any position, totaling less than 900,000 shares. To put that in perspective, the stock traded 519 million shares yesterday. This is not a Fidelity wealth management client. It's not even in the same universe as a blue chip like Apple stock or a high-growth darling like Nvidia stock. This is a different sport entirely. Traders using platforms like Interactive Brokers, which caters to more sophisticated high-volume trading, might be playing the volatility, but the long-term investment case is paper-thin and rests entirely on future projections. Let's dig into the reality of this game-changing joint venture. The definitive joint venture agreement is not even signed. It's intended to be executed on or before December 15th, 2025. This is still a framework, a plan. Furthermore, Nuburu Defense is expected to contribute up to $10 million in capital funding to this JV. This raises a critical question. Where does a company with zero quarterly revenue and a collapsing legacy business get $10 million in capital? This will almost certainly require significant shareholder dilution through future offerings, putting downward pressure on the very stock price that just spiked. The $100 million projection by 2028 is an enticing carrot, but it's 4 years away and dependent on successfully building an entirely new business from scratch in a highly competitive defense sector with a partner, all while needing to raise the capital to fund it. It's important to understand what Nuburu's original business even was. The company was a pioneer in high-performance blue laser technology. This tech is genuinely interesting. Because blue light is absorbed more efficiently by metals like copper and aluminum than the more common infrared lasers, Nuburu's technology was aimed at welding applications in e-mobility, like welding copper hairpins for EV motors, and battery manufacturing. It also had applications in 3D metal printing. This was the original story when the company went public. The problem is, that story never translated into a sustainable business. The market for this technology, while promising, is competitive and difficult to scale. The fact that revenue has fallen to zero suggests that either the demand wasn't there, the competition was too stiff, or the execution failed. This defense pivot is an admission that the blue laser business as a standalone entity is not working. So, what is the future outlook here? This is the ultimate case of expectation versus reality. The expectation, which drove the 24% rally, is that Nuburu has just successfully shed its failing legacy business and acquired the pieces to become a $100 million plus defense contractor, specializing in drones and resilience software. In this scenario, 36 cents is an absurdly cheap entry point. The market is pricing in the possibility that this new management team, under its dual CEO structure, can execute this highly complex pivot. The company is certainly making all the right moves from a press release standpoint, targeting high-growth, headline-grabbing sectors. This is the narrative that keeps the Robinhood app traders clicking buy. The reality, however, is that this is a 30-cent stock with a market cap under $50 million that is attempting a corporate Hail Mary. It is trying to enter the incredibly complex, regulated, and capital-intensive defense and drone market. It is doing so with no current revenue stream to fund its operations or its $10 million JV commitment. The $100 million projection is just that, a projection from the company itself, not a signed contract. The risk of failure is extremely high. The risk of dilution is near certain. This stock is not a value investment in the traditional sense. It's not a candidate for self-investing in a retirement account. It is a speculative vehicle, a lottery ticket based on a compelling press release. It's a fascinating situation, and it brings up a good question for everyone watching. Comment below if you think this defense pivot is a genuine turnaround or just a microcap PR move to survive. Are you holding shares, or are you staying far away from this kind of volatility? Looking forward, the key catalyst